All right. Thanks everyone for joining me again. This is part two of the advanced candlestick technical analysis video. This one is for my followers. I really appreciate you joining me here on a Sunday. I know everyone's busy, but I really feel like what I'm going to teach you is really going to help with your trades. It's really going to help you see the market in a better way. And I really want to help at the end of the day. All right. So the first thing is the main concept that I want to teach you guys about in this webinar is the morning reversal and just trading at the open in general. So those that have followed me for a long time know my style is really trading the open because the open has the most volume. And we want to trade when there's volume because volume will give us reliable patterns and movement. And when we have reliable patterns and movements, we can make profit. If they're not reliable, then we're just gambling because we have no idea, what the expectancy is, how much we can make, etc. So at the morning, you really want to look for either a potential reversal or you want to look for trap traders. And like I have written down here, timing is everything. So the earlier a pattern sets up, the better it is. And then I'm going to go through examples for the whole week on SPY on a 5-minute chart, and I'm going to talk through the psychology of everything. And then we're going to talk a little bit about building systems and expectancies. Okay, so let's look at Monday. So Monday, we had that huge gap up on futures and in SPY. And the thing that I want to teach you guys is about reading the candlesticks. So the first candlestick, we had a big red candle, right? So anytime the gap is huge, we have to remember that anyone that bought back here is very, very excited about this gap and they're looking for a reason to lock in profits. And a lot of the times they'll be trailing the first 5-minute bar to protect their gains, right? But the key about this is looking at this candle right here. So if we look at this candle, we see that there's a long wick, right? So we know that means sellers are in the market and they're pushing the price down. But what's more important is identifying that this candle is a trap. And the way we can do that is let's look at the high of this, 64.38, and this one is 64.32. So at one point, this candle actually broke this high. So from that, we can see that there was some people that went long above the high of this candle. And because of that, their stop loss is likely below the low. So this is what we call a trap because buyers were trying to buy this breakup and they wanted to push the market up, but it turns around immediately on them. And anytime we have that type of action, we have violence and a trap in the market. So this is a great candle here to go short on. So you can go short anywhere at the close, below the low, you can go short in the middle, whatever. So there's multiple ways that I teach you guys to do that. It's up to you. But here's the other main point that I wanted to point out. So this candle is the high of the day. And that's why I say timing is everything, because if you're taking candles within the first hour or hour and a half of the day, you have a high chance that it's either going to be the high or the low of the day. We don't know which one it's going to be, but you're playing the odds. So when this candle comes in, if you decided that I'm going to say that, 1 second, I'm just admitting someone else. If you're going to say, hey, this is what I expect the high of the day is going to be right here, then that's what you're playing for. And it doesn't matter if it's right or wrong. All that matters is in the long run that you're going to be, your risk to reward is good. So let's look at the example of the risk to reward on this type of trade. Okay. So if we shorted, let's say below the low to stop above the high, and we just held this into the close. So that's four times your risk. So if you put $1,000 risk here, that's $4,000 as an example. Or if you wanted to buy puts here, this type of move on puts, depending on your expiry, can be like 5 to 10 times more than what you paid for it. So I don't really specialize in the options because I use the futures mostly for my trading, but that's just an example. And the candlesticks help you with your timing, okay? And then the other candlestick that was really, really important that day was this one, because you guys know that I really love inside bars. So this is an inside bar, this one in blue, and I have my own system that I wrote for trading these. So the inside bar is very important because we had 3 red bars down, and then we had an inside bar. And if you look at the wick of this inside bar, the candle was up here at one point. So this candle was a green candle up here. So again, we could see that the bulls are trapped again because they tried to push it up here. and instead they got flipped around. So these wicks are very important. And even if you took a little scalp here, that's a winner. Or if you shorted with a stop up here, you could have still been in this move holding to the low of the day. All right. So that's the point that I'm trying to bring, is that the candles in the morning, in the earlier in the day, are very powerful, and they can be the high or low of the day if you play it right. And the timing and understanding the candles are the most important thing. So this candle, because it broke the high of the first bar, we know that there are trapped traders here. And some traders are going to take a stop here. Some aren't. They're going to bag hold. And when they do bag hold, this is how we can get a huge sell-off like this, right? All right. So the arrow and the inside bar, that's just a part of the tool. I don't use the arrow at all. For the inside bar, I wrote my own rules. The arrow comes with it, but I really like to use the context. The reason I have the indicator is because it'll highlight the bar for me, so I know, okay, this is an inside bar. Then I use the context to determine how I want to play. All right. So let's go on to the next day. So then on Tuesday, what happens here? So this is another example of understanding the bars. So on Tuesday, we gap down, right? So this is the close of the previous day. This is the gap. So we gap down and we rally into the morning. Look at this bar. This bar is an inside bar with a long wick, right? So we know buyers were here. They bought this market, and now they're even more excited because they think that this is going to be the low of the day, and they're buying more, and this wick is here, right? So understanding that there's buyers here, there's buyers here, there's buyers here, we get this inside bar that pops up. So how can we play it to take advantage of the traders? Well, we know that if this low goes, there's going to be trapped buyers, right? Because they were buying here, they're buying here. Look at these wicks. You can see they're buying. So the trade on Tuesday is taking a short below the low of this wick with a stop above the high, because we know this is where their stop losses are. And this is what I mean by taking advantage of trap traders, right? So if we short right here, stop above the high, and I actually took this trade here and I was able to get 3 times my risk, right? So for me, on any given day, I can be risking between $300 to like $600 or $700. So let's say I risk $500 on this trade, okay? So I'm short here with a stop here. If I'm wrong, I lose 500 bucks. But if I can get 3 to 1, I'm gonna make 1,500 bucks. And that's how you really trade. I'm gonna get back to that about systems and stuff after. But I wanted to really go through the candles first. All right, so now let's go to the next. And if you guys notice, right, I'm just looking for the best candlesticks at the open. That's the way I trade. I have a cutoff, 11 o'clock, 11:30, I'm done. Because I know the probability is going to go down as the day progresses, because there's less and less volume. There's more trapped traders, and it's going to be choppy. Like, look, you don't want to be trading in this type of action here, because you're going to get burnt on both sides, right? So this is why I take the best trades at the open. All right, so now let's look at this day. So this is Wednesday, and we had a gap up, right? And then I want to point your attention to this block of candles here, right? So we had an inside bar here, and we had another inside bar here, and then we had this big, big hammer candle. So because we're gapping up, we have to understand that the bulls are in charge of the market anytime we gap up, right? Most of the time, if we gap up, we're likely to have at least one leg pushing up, because there's a lot of trap shorts from the night before. But usually at the open, we're going to have a little bit of selling, because anybody that bought here, they have to lock in some profits, right? So that's why you see a little bit of selling, and then usually a rally, and then either it's going to roll over or it's going to just continue straight up, right? So this block of candles, I wanted to bring this to your attention, because the first thing is, if we take from the close to the high of the gap, we can see that this level is a 618. Okay, so when we see these wicks at the 618, we understand that the buyers are stepping in here. So we're using the Fibonacci with the candlesticks here to help us see that yes, the 618 is working, and there's buyers 1, 2, 3. And really, by this third long wick here, this is when we know for sure that the buyers are in the market, right? And then that's how we can enter this trade right above here with a stop here. And the way we do it, so if we draw these fibs again. So I have 2 styles of trading the fibs in my systems. One is waiting for the candlestick and one is doing just limit entries like so, right? But it all depends on the context. So if we were able to get in here with a blind limit order, stop at the 786, and then we just take this back up to the high of the day. Let's just say we take it somewhere around here. Okay, so like 5 times our risk again. So if I'm risking $1,000, that's $5,000. If I'm buying options here, calls, same day expiry, this could be 5 or 10 times your money. All right. So then let's go to the last 2 days. So we had the Thursday. So I wanted to point out, so on the Thursday, we opened right at the previous day's low. So anytime we open right at the previous day's low, I'm looking for that to be support. And we wait patiently, at least, until we see who's really trapped, right? So we had the buyers here, right? They stepped in and then the short stepped in and they pushed and they broke through this low. See how important that is that they broke through this low? But what happens when they break through the low? They don't have momentum. Instead, it becomes a big piercing bar, right? So this is how you read the candlestick. So now we know here the bulls are back in control. The shorts tried to short below the low of the day. The support is holding and we can take, then after that, we actually even have another indicator. We have another inside bar. So this was one that I took during the week as well. And then we can easily just get in long right above the inside bar. We'll put a stop below the bar, below the low of the day. It doesn't matter. And we can take it for about 2.83, depending on where your entry is. And when you're taking these setups, you need to scale out of your position, right? So when you get to like 2 times your risk, 3 times your risk, 4 times, you keep layering out of your position. That way, you are still in the trade if it goes to the moon, but you're also protected and you're paying yourself, all right? And then the next setup on the day was right at this gap fill, we have this inverted hammer, right? So if you were to look at this chart to that point, you would probably think it's really bullish, right? But the point is combining candlesticks with placement. So now if we get this inverted hammer at the gap fill, we know we took a normal inverted hammer, which is maybe, let's say 40% accuracy or 50% accuracy. We add the gap fill to it. Now this is a 70% accuracy trade, right? And that's why we have that roll over there, okay? And then the last setup, or actually, sorry, we have 2 more days, I think. No, this is the last day, yeah. So this was the last, so this was Friday, and this is a trade I actually called out on Twitter. So again, placement and the pattern. So this is the previous day's high. I always have the previous day's high marked and the previous day's low and the overnight high and low. And I always post that in the pre-market plan for you guys. But when we get up here to this zone, right, we see something very important. We push to the previous day's high and we have a hammer, right? So we know that bulls, they first started buying here, then they started buying here because everybody at this point is thinking that we're just going to break through the high and rally. But if you're reading the candlesticks and you be patient, what's the very next candle? The very next candle is an inverted hammer. So now we can see the bulls are trapped, right? They pushed here, but as soon as they pushed, they got shut down. So this was the example of combining the placement with the previous day's high, and then we could short right below the low of that inverted hammer. And then at the very lowest, it was 3.7 risk to reward, which is great. So to put everything into perspective, if you can average about 3 to 1 risk to reward, you only need to be right 26 out of 100 trades to make profit. And that's the biggest secret of trading. You can trade anything. You can trade candlesticks, you can trade fibs, you can trade Bollinger Bands, RSI, whatever. But is your risk to reward good? Most traders, it's not. And the reason is because they don't have a system, they don't have rules. So if they're up like 0.5 R, they'll just sell it. But then their losers are full losses. That's not how you make money. You have to have a positive risk to reward. That's what, and now I'm circling back to this topic of building a system with proper risk to reward. So I'm giving you guys all the setups. You can say, hey, on a gap up, I want to short inside bars. That's a system right there that I'm giving you guys for free. Now it's your job to go and take that and test it over 100 trades, 200 trades, see what the win rate is, see what the expectancy is, and then determine if you have a profitable system or not. And that's what I've done all, my 5 years in trading as I've built systems, because the system for me is what gives me confidence in what I'm doing. And if I don't have one, I feel like I'm gambling. And I want to treat this as a business, not as a hobby or for fun. So basically, to summarize, the candlestick is very important with the placement as well as who's trapped. And I gave you guys examples throughout the week. So basically, recent trades, and you're gonna see that all the time. And I want you guys to just be more aware of what you're doing and really look for who's trapped. And if you guys want to work with me, I have my own systems. It's on tradingwars.com. I have the apprentice program. You guys already know that. So, and if you don't want to do the testing and if you want something that's profitable, you can work with me directly. But otherwise than that, be creative, build something that you like. Trading is about being creative. There's so many ways to make money. So figure out something that you like and then do the due diligence of testing. All right. So I'm going to leave a few minutes now for questions. Did you guys understand all of that? Was it clear? And if you have any questions, please drop them in the chat right now, and then I'll be happy to answer them. Or it doesn't have to be a question. It could be any comments or anything like that. Anything that you guys want to talk about. Or if you want, we can also look at where the market is right now and like what we think can happen and things like that. So let me know what you guys think. Do you chart on SPY? Yes, good question, Chad. Yeah. So everything for me in terms of testing and everything is done on SPY, because SPY is RTH, is regular trading hours, and all my trades, 90% of my trades are in regular trading hours because that's where the most volume is. I try not to get involved too much overnight, but if like today on a Sunday with gaps, if we have a big gap up, like today we have a big gap up, I'll take a chance and get involved, but with very small risk. But once I see the trigger on SPY, I relay that order into futures contracts because that's the instrument that I use. So, but I use SPY to really help me see the gaps in the chart because SPY doesn't have any of the overnight action, which is a lot of times more confusing than helpful. Friday morning, how did you decide to use 15-minute candles versus 5 minutes? So I'm always looking I'm looking at all time frames for setups, but on Friday, it was actually, that setup is on the 5. So everything I showed you here was on the 5-minute chart, but I have systems that I use on different, so this is on the 5. I have systems for different time frames. Every time frame is different. Every time frame has a different personality and has different risk to reward. On a 5-minute chart, you can really go for home runs. You can go for 3-to-1, 4-to-1, because when you're catching something, you're catching it at the apex. If you're on a 15 or hourly, you have to be a little bit more conservative, but it's a little bit more reliable because there's more volume involved, right? There's more volume involved in making a 15-minute candle than a 5-minute candle, right? So as an example, let's look at the 15-minute chart. And so let's just take let's go back to the beginning on the 15, right? And one of my systems, my inside bar system on Trading Wars, I use is actually a 15-minute setup, right? So here's an example of a 15-minute setup that I would do in my system. Okay, so we had a big gap up. We had an ignition bar here. This ignition bar is a green bar with a long wick, and then the inside bar also has a long wick. So based on my system, I would short below this low with the stop right above this high, and I would have held this for between 2 to 3-to-1, depending on how it moves. So over here, we got that pullback and that retracement. That's an easy winner, right? So put this in perspective. If I make 3-to-1 here, right, and then let's say I make 3-to-1 here, so that's six times my risk. Even if I lose every other trade for the rest of the week, I'm still going to make money, right? Because with a 3-to-1, you only need to be right 26% of the time. So by me, if I take like let's say 5 to 10 trades in the week and I win the first 2 like this off the bat, I already know it's going to be a great week. So that's the power of risk to reward. All right. Yeah. Okay. So I don't see any other questions. I appreciate your guys' time. I appreciate you joining me here on Sunday. And thanks for following along. If you have any other questions, you can DM me.